Hi guys, welcome. It's Sunday, September 12th. My name is Dave Coker and this is Talking About Finance. All right guys, let's start out like we do every week. We're going to take a look at the S&P 500 and I'm taking a look at what happened last week. You can go over to the wonderful FinViz site and construct your own heat maps of different time ranges, different factors, things like that. But take a look at this and remember the way to read this. Red and green mean exactly what you think. Green is good, red is bad, meaning you're losing money when it's red, and when it's green, you're making money. And of course, the severity of the loss or the how big the gains are is illustrated by the color. Bright green is very, very good. Dull green is still good, but it's not as good as bright green. And then finally, you get down to the reds. Dull red is a slight loss, relatively low, and bright red is something you really don't want to see. So we had a really bad week last week. It was pretty interesting. You can see healthcare got banged on in a major way, industrials, lots of red on this map. There's some green, some's actually done pretty well. It's curious, Apple got hit. We'll talk further about Apple, but they had a court ruling that went against them. So that caused some issues there. I'm not quite sure why Microsoft is down. Google got whacked a little bit as well. It might be some of the spillover from Apple's court decision about apps. And Facebook, my God, I can't believe Facebook is up. They came out with these really lame sunglasses last week. If you get a chance, take a look at them. Boy, those things, I would not wear them, first of all. Got my own sunglasses. But aside from that, the idea of walking around with a camera on your face and you can just record and there's no real visible way to tell it's recording. Long story short, some people are going to get beaten up and probably pretty severely when they start walking around with those things. And it happened with Google Glass. If you go back, about 8 years ago or so, maybe 6 years, people were getting beaten up because they walked into nightclubs and pubs and God forbid they go into changing rooms. I'm sure that happened. But people just don't want to have their privacy invaded in every situation. So it'll be interesting to see what happens with those. But yeah, Facebook was up about almost 1% on the week. Now, when you take a look at this, you might think, my God, we did really bad. Well, yeah, we did sort of badly, guys. But what happens is it turns out that the stock market, the S&P 500, I should say, is up almost 21% year to date. In fact, it's up, I looked right before I came on camera, it's up 20.48, which is an enormously good performance. The VIX, the volatility index, remember we've spoken about this, also called the fear index, traded up. So we're seeing higher vol, and the fear seems to be picking up a little bit because September has a bad reputation in the stock market. But it's curious, is it warranted? Well, if we go back and take a look at the period from 1980 up to 2020, a good sample there, the average price return for January to August was 6.3%. For September, over the same horizon, 40 years, the September is down 0.6%, and then October through December is up 4.3%. Now, in terms of volatility, it does seem to be more volatile for periods other than September. So January through August, the volatility, the standard deviation, I should say, was 11.4 points. For September, it was 4.4 points, and for October through December, it's 8.8 points. So all I can say is keep the faith. There's really no other place. Tina applies here. There's really no other place to put money these days. We'll talk about it a little bit further. But if you're looking for returns, it really is the stock market. Tina, of course, meaning there is no alternative. So I don't know. I know I told you guys, I've got dividend money coming in every month. And for years, not for years, I was just letting it pile up. And then I would go in periodically and buy some stocks. And I was very, very active over the past year, 18 months or so. I'm buying stocks a great deal. And I stopped about 2 months ago. I don't know. I'm going to let the money pile up. And if there is a sharp correction, I just might buy more stocks. I'm not totally sure about it. But no matter how we look at it, it was a pretty bad week for the S&P 500 last week. In fact, it was the worst week since June. So stocks got whacked. Oil was up roughly 2%. USD against the G7, the other 6 members of the G7, I should say, was up about 23 basis points. So it's a little odd, the performance that week. But even so, even with that drop, markets, guys, are still pricey. This is, of course, some of my own research that I peddle, I sell, and I give it to you guys. You just don't get the, I think there's about 1,500 words around this one, but it's okay. I'll talk the points through. Here we got the price to earnings ratio. We're looking at trailing 12 months, meaning we're looking back. And you can see here, guys, the price to earnings ratio, the average is roughly 16.95 over a 40-year horizon. And you can see we're trading at 34.78. So we're still pretty pricey, even though there's been a drop And you can see it was up to about 42 at one point. So even though there's been a drop, we're still pretty pricey. We're nothing like we were before the global financial crisis. Go back to 2008 markets. S&P 500, the PE was 123 and change. So we still got to keep this in mind. It's still an expensive market, but there really is no other place to put your money. Well, of course, I do property, I do commodities, do crypto, but in general, the bulk of my assets, of course, well, leaving property out of it, is in the stock market. You just got to do that to make money. Even though we saw Apple got hit, and they got hit because they lost a court ruling about the App Store, and basically what the judge said is that Apple can't compel developers, I should say, who build applications, cannot compel them to book additional fees. And apps, they give you a lot of stuff for free, but then there's always stuff not always, very often there's stuff that you can purchase, increased services or items, whatever, it doesn't matter. But they can no longer compel users to solely go through the App Store. And Apple, keep in mind, guys, Apple was taking 30%. So that was interesting to see that they lost that case. I think they're going to appeal it. It also hit Google a little bit because they both charge, and it's remarkable that they're both charging the same amount. That just doesn't look too good at all, right? That a little bit of collusion there. But regardless, we'll see if this holds forth. Now, it could really hit Apple's revenue. I've read some research, nothing definitive yet, but we'll see exactly. It could really hit Apple in a major way with their revenue going forward. Now, I like to point out when academic theory doesn't work, and it's remarkably often it doesn't work. And academic theory suggests you're better off holding a diversified portfolio. Of course, we know that. We've talked about that here, right? And they further suggest that you diversify globally. But does that really work? So going back from the period 2010 up to 2011, we've got the S&P 500. We've got an ETF tracking Europe. We've got an ETF tracking emerging markets. And we've got an ETF tracking the Pacific area. And you can see here, guys, there ain't no place but the U.S. And I'm not really a patriot like that, but the data's here. You can see if you put money into the U.S. in 2010, you've gotten a 404% return over the horizon. Annual return, roughly 14.83 over the period. That means every year your wealth was growing at almost 15%. Look at the underperformer. Look down here with emerging markets. And that, I have to admit, I'm a little surprised to see this data, these results, because, a lot of people talk about emerging markets, the future. I've certainly done that myself, but you ain't going to make no money there. Annual return about 4.75%, roughly 72%. It's nothing to sneeze at, but still it's not in the same realm as the United States. And Europe, once again, annual return 6.71%. If we look at the Pacific area, 7.33%, but each, Europe coming in at 113% over the same horizon, and the Pacific area coming in about 128%, they're dwarfed by the United States. Could this continue? We're not totally sure, but it is interesting to take a look at these things and just, as I said, debunk these myths, because I'm very flexible in my thinking when it comes to money. And yeah, even though I do hold a globally diversified portfolio, I've got most of my wealth focused on the United States in terms of the stock market. I think I've got one dividend-paying, of course, entity that focuses on emerging markets. And I don't really care about the share price return there because I just want the cash flow. And it's yielding, I believe, about 12%. I'd have to look at it again. So that's okay. But still, it's really interesting to see that this academic theory just doesn't work, or at least it didn't work over the past 10 years or so. Now, there really is, when we talk about putting money in the markets, guys, there really is no alternative. Tina applies again. Here's something else. I pushed this out about a week ago to my clients with about 1,500 words. What we're doing is we're looking at bond spreads. And when you talk about a spread in finance, I think you're talking about a difference. So if we take a look at the difference between AAA rated bonds, and if we look at the spread between AAA and CCC rated bonds, it's interesting. It sort of tells us something. Let's talk about this. AAA, of course, is the highest rating, the best debt that you can purchase. And CCC is one notch above default. Now, I take a lot of risk. I don't believe I hold any CCC directly. I might have it through a couple funds, but I definitely own BBBs, without a doubt, because I like high yield to begin with. I used to work in that business in banking. I know it backwards and forwards, and I knew this was going on. And this is something that I did mention this at a conference about a month ago. You can see here, guys. Now, horizontally, we're going all the way back to 97. And you can see from the period 97 up to the recession, and on this chart from St. Louis Fed, vertical gray bars represent recessions. So you can see that the early 2000 recession we had, it was roughly 2001, the spread, the difference in yields between triple C and triple A was 12.38%. Post that recession, coming out of that, in the run-up up to the global financial crisis, that spread had compressed down to 9.53%. And then after the global financial crisis, running right up into our COVID collapse, or whatever we're going to call that, I don't think we've really decided yet, 8.94. And after the COVID recession, 8.15. So spreads increasingly being compressed. Yeah, they tell us tales about investor confidence, but they also tell us tales about the quest for yield and the fact that just people are putting money into things. And I really hope they know what they're getting into. I certainly do, but I'm not so sure your average investor does. They just see this juicy yield, 800 basis points, and they dive right in. It's a really interesting time, but still, guys, TINA applies. There is no alternative. Why? Well, the Fed's been engaged in quantitative easing, which basically means they're buying stuff. So they're buying stocks, they're buying bonds, they're buying a huge array of financial assets, and that is lifting share prices. That is compressing yields. Well, we heard a good one Friday night, still waiting for confirmation from the Fed, but it came from sources that I tend to trust, and we were chatting about it on the Telegram group where all this stuff comes from. And yeah, the rumor is that the Fed's going to start tapering after November, and they're going to finish it by July. My gosh, not quite sure what's going to happen to share prices in that environment, because your biggest buyer is no longer buying. It'll be really fascinating to see exactly what happens there. And finally, guys, America, we know, borrows from lots of different nations. We tend to finance an enhanced standard of living by borrowing money. Let's take a look at the budget deficit. Let's take a look at the surplus or deficit that we have. And you can see in World War I, we went deeply into debt at the time. It's all relative, isn't it, right? So we went into debt, paid it off. We had issues in the 70s. We had Vietnam, Ronald Reagan, and Clinton. And Clinton, I didn't like politically a lot of stuff he did. And of course, I didn't like that whole scandal with Monica. But aside from that, one thing I liked about the guy was he started to pay down the debt. He was running a surplus, in other words, in the budget. And that was actually pretty cool. So he started paying down the national debt. And there's lots of historical tidbits there that we'll talk about maybe when the time comes. But regardless, you can see that between Vietnam and Reagan, we had huge deficits. And then Clinton swung it to a surplus and actually started paying down the national debt. Now, coming out of the global financial crisis and all these other issues when we went to war with the world, basically, we started running deficits, and they've been getting bigger and bigger and bigger. And I want you to focus on the box on the right-hand side, and you'll notice in the box on the right-hand side, there's bars representing how much our deficit is. And you can see we are in territory that we've never been in before. Nobody really knows how this is going to happen. And yet Mr. Biden wants to grab another $3.5 billion, or trillion, I should say. It's a very, very odd time right now in the United States. How's it all going to end? Well, people don't talk about this, but I talk about it, right? Yeah, we're going to default. Now, we did this in the 80s with the Japanese. It wasn't a hard default, but what happens is we had a huge debt to the Japanese, and we had inflation in the country running very, very hot for a protracted period of time, about 6 years, and it eroded the value of the debt in real terms. Those times are coming again right now. If you doubt me, just look at inflation. We've talked about it in prior weeks. Inflation's starting to surge in the States, and it ain't going away anytime soon. So yeah, I think we're just going to erode the value of the debt. And by doing so, we'll erode in real terms the size of the debt relative to the real economy. And we'll see what happens there. All right, guys. That's it for this week. Been great chatting with you. Now, once again, looks like it's going to be a good week. I've been tracking the Gulf today because, they trade today. Things are looking pretty good. We'll have to see what happens going forward. I got a good feeling about this week. We can't tell if there's going to be an exogenous event that'll cause something weird to happen in the stock market, meaning a correction or maybe a full-on crash. Who knows? Things are real expensive. But regardless, keep the faith. Save up your capital, take a look for stocks that you find attractive. And of course, you know my whole thing, guys, is that I really don't buy anything unless it pays me a dividend. There is one exception to that, and that is Bitcoin. You know we're going to talk about Bitcoin. We talk about Bitcoin every week. Well, I try not to be honest with you, but still it comes up. Now, this came out last night, and I was at a show last night with my wife, and I saw the Telegram channel was very active, so I covertly looked at my phone. I was like, oh my God, this is wild. And now you can Google this story up, but Fidelity Digital Assets, the Bitcoin custody side of their business, they're estimating, and they've got two different models they're applying. They're estimating that one Bitcoin will be worth $1 billion by 2038. Ain't that far off. My God, I'm really old. Maybe I can hang on. I hope so. Got a lot of Bitcoin here, guys. But we'll have to see. Now, I just laugh at these things. I really do. I've mentioned this before, guys. I have a lot of Bitcoin. I'm still buying Bitcoin every week, by the way. I've been doing so for years. I typically buy it Fridays. And people ask me all the time, why do you buy and why don't you sell? Well, first of all, I don't need money. I've got money, from the property business, from my job and my consulting business. I don't need cash flow. And if I did sell Bitcoin, it would just it'd drive up my tax bill, and I certainly don't want that. And also, the biggest reason, guys, is this. I know, given the dynamics, I think it's highly likely, I should say, that Bitcoin in the future will be worth more than it is today. Now, that doesn't mean tomorrow it won't drop by 30%, because we know it's one fun ride. It's a very volatile asset. But if you look over a sufficiently long horizon, I'm talking years, Bitcoin will be higher in the future. Will it be worth $1 billion per coin by 2038? Couple arguments there. You take a look at the number of the millionaires on the planet, and then if you start to consider that there'll only be 21 million Bitcoin ever mined, yeah, it's possible we're going to see sharply higher Bitcoin prices. Whoever came out with this, I read the articles, I can't recall the gentleman's name. There's a rule of forecasting that we used to say on Wall Street. If you name the price, don't name the date. If you name the date, don't name the price. Well, this guy blew both of them because he said it's going to be worth $1 billion by 2038. I don't know. Maybe they'll keep him around until 2038, and maybe he'll have a job. Maybe he won't. Not sure. But I do know it's going to be worth more. So keep the faith there, guys. I bought Bitcoin last Friday. I was tempted because of the crash that we saw, the mini crash in Bitcoin on Tuesday, to buy more just to show solidarity. But I thought, nah, I got a system. I got a system that works really well for me. Just buy it once a week on Fridays and forget about it. And I stuck to that. I'll be buying Bitcoin again next Friday, regardless of what happens to the price. I just buy same amount of money every week. So keep the faith, guys. You're going to have a really good, a really profitable week. Got a good feeling about this. Take care.